Okay, let's get into your pro picks, your highest conviction areas in fixed income. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, these are, you're not giving specific issues, but you're giving areas of the market to look in. So you want to be long the Canadian front end, which means like a 2-year, for example, not a 10-year.
Correct.
Tell me why.
Right. So long 2-year Canadian notes. So prices higher, yields lower. And we talked about it a little bit during the podcast, this idea that the bank is probably going to cut rate. I think the bank's going to cut rates at least twice before June of 2026. And market pricing is 0. So if there's 50 basis points or more worth of cuts that are yet to get priced in, you'll feel that maybe in the entire curve, but particularly at the front of the curve. And 2s to your notes are generally the best way to message that. So you want to be long, so prices higher and yields lower for all the reasons that we talked about: housing, population growth, the labor market, all those things that I think might be at risk here in Canada, and the bank would need to cut rates.
And the fact that, the rate cut's not priced in. So let's dovetail that with your second idea, which is to short the U.S. front end. We already know that you don't love the long end, the 30-year.
Yeah.
Why don't you want to be in 2-year notes in the U.S.?
So this is a bit more a tactical trade. I would say that the Canada one's a little bit more cyclical. This one's a bit more tactical because I think once we get through the December FOMC meeting and the Fed cuts rates, the Fed's probably going to be on hold until May at least, and let's see what happens with the Fed governor and the Fed chair and all those things. But the market is pricing in Fed cuts for the first, let's call it third plus of the year through April and into May. And I think that that's quite unlikely. And if that 30 or so basis points, 20 or 30 basis points needs to get unwound, then that all other things equal, that should mean prices lower, yields higher for the 2-year note in the U.S. And so you would expect to see yields rise from that perspective.
Okay, so that's kind of your out of consensus views on rate cuts on both sides of the border showing up in these trades.
That's right.
Okay, your third one, let's try and explain it so my mom can understand.
Okay.
Emerging markets, FX carry.
Sure.
Love a carry trade.
Yes.
Tell me what way you want to be positioned and what this strategy could be useful for.
So carry trades are generally, you can look at them a couple different ways, but one way to look at it is to sell low yielding assets, or in many ways currencies, and buy high yielding currencies. And this often ends up in the emerging market space. And then generally, like from a very 50,000 foot macro perspective, carry is generally a quality environment where high growth or high beta assets are generally outperforming broadly. So you can kind of talk about it both ways. I think we're talking about it from a currency perspective.
I think about it like you borrow in a low interest,
borrow in yen or Swiss.
Invest in the U.S.
That's right.
Because you're not paying that much on the debt.
That's right.
And then you're getting more return in the U.S. and then it blows up whenever interest rates in Japan spike higher.
That's right, exactly. And so this idea around carry, and very back of the envelope, is if U.S. rates aren't moving significantly higher and the dollar's not moving significantly higher, U.S. dollar's not moving significantly higher, then it's generally a good environment for carry. Now, I do think that we could see a little bit of a move higher on the rate side in the U.S., but I don't think it's necessarily going to be a big spike higher. But I do think that we've had a very constructive environment for carry for most of 2025. The dollar's been kind of choppy in a range. The U.S. rates have been very choppy in a range, particularly since Labor Day, since early September. And it's been very constructive for some of the high-yielding EM currencies like Brazil, Mexico, South Africa.
And is there an easy way to get access to those currencies, or you just go out and buy them?
So you could go out and buy them. You can buy funds and ETFs that have that. I mean, we have that in terms of QEBL and QEBH ETFs, which are hard currency and local currency EM local debt that have the currency exposure as well. So that's one way, and other firms offer them as well. And one thing, I spent a lot of time in the States, working in the States, and came back a number of years ago. And one of the things I noticed when I came back is that Canadian investors were not paying enough attention to emerging markets. And it's real I think it's something that Canadian investors should really pay attention to. And one of the reasons, first of all, the asset class is very interesting in and of itself, offers good yields, and you have to understand the idiosyncratic risks and all that, fine. But in Canada, our base currency is Canadian dollars, no surprise, right? And Canadian dollar is not an emerging market currency, but it is considered within the FX world a high beta currency. And so if, let's say, I'll just take Mexican peso because it's the most liquid EM currency. If Mexican peso is selling off for whatever reason, then most of the time, the Canadian dollar is probably also selling off. And so that means that we have a little bit of a beta to having emerging market exposure, whether it's local currency debt or that. So you kind of have this natural hedge as opposed to a US dollar, which would go the other way. If you're a US investor, you buy emerging markets, it doesn't go your way, it's worth less, and you have less emerging market currency X to buy your US dollars back.
Whereas if this trade goes well, your Canadian dollars have gone up and your
that's right.
emerging market
there's a higher beta. And so I find that Canadian investors are a little bit underinvested in emerging markets. And so I like to kind of spread that message and just think about that as another way to pick up yield within any portfolio, your portfolio, whether it's institutional portfolio or a PA personal portfolio.
You got that, Mom? We'll see. Dustin, thank you so much for joining me. It's been an absolute pleasure.
Same here. Thanks for having me.